Did you know that claiming Social Security at 62 could actually put an extra $100,000 or more in your pocket over your lifetime, compared to waiting until 70? Most of the advice out there tells you to wait, that it's always better to delay benefits to maximize your monthly check. But that conventional wisdom is often dead wrong, especially in 2026. I'm talking about the actual math, the overlooked variables, and how real people, even those with average life expectancies, are often making a financially smarter decision by taking their benefits early. We're going to break down why the wait until 70 advice, while sounding good in theory, frequently ignores the very real costs and opportunity costs that most retirees face. We'll look at the break-even points, the impact of inflation, and how different claiming strategies play out under various scenarios. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Alright, let's dive straight into it. You've probably heard the conventional wisdom. Delay claiming Social Security benefits as long as possible, preferably until age 70, to maximize your monthly check. It's advice echoed by countless financial planners and even the Social Security Administration itself. But what if I told you that for a significant percentage of Americans, claiming benefits earlier, at 62 or 65, actually puts more money in their pocket over their lifetime? And I'm talking about hundreds of thousands of dollars more. The math behind this often gets ignored, overshadowed by the allure of a bigger monthly payment. We're going to walk through the actual numbers, looking at scenarios from someone retiring at 62 with a $1,500 monthly benefit to someone waiting until 70 for a $2,600 benefit. We'll even factor in inflation, using recent CPI data to understand how purchasing power shifts. This isn't just theory, we're going to apply what we learned from the 2022 rate hike cycle and the subsequent market shifts to understand why the old advice might be fundamentally flawed for today's economic landscape. The lesson here is that maximizing your Social Security isn't a one-size-fits-all strategy, it's a deeply personal financial decision that demands a closer look at the actual present value of your future benefits. But here's the often ignored elephant in the room. Social Security is projected to cut benefits by 20% in just about a decade. You've probably heard the headlines about Social Security going bankrupt. That's not quite right, and it often distracts from the real, immediate challenge. The system isn't going bankrupt in the sense that it will cease to exist or pay out nothing. Instead, it faces a significant solvency challenge. According to the 2023 Trustees Report, without congressional action, the Social Security Trust Fund is projected to be depleted by 2033 or 2034. What does depleted actually mean? It doesn't mean the money runs out completely. It means that at that point, Social Security will only be able to pay out approximately 80% of promised benefits from ongoing tax revenues. The trust fund isn't some market-beating hedge fund, it's invested in special government bonds. Its depletion simply means it can no longer cover the full projected benefits. Think about what a 20% cut means for someone relying on Social Security. If the average monthly benefit today is around $1,800, that 20% cut translates to a sudden loss of $360 per month. That's a significant hit to purchasing power, especially for those who plan their retirement around that expected income. For someone who claims at 62 today, they'll be in their early 70s when this potential cut hits. For someone delaying until 70, they might only have a few years of full benefits before the reduction. The lesson here is that relying on the full projected benefit without considering this looming date could leave a substantial gap in one's retirement income. But what if everything you've been told about fixing this crisis is actually backwards? But what if I told you the core problem isn't political gamesmanship, but a fundamental demographic shift most people misunderstand? For years, we've heard that Social Security's issues are just a political football, kicked down the road by Congress. However, that narrative often obscures the profound demographic and economic shifts that are the true drivers of this impending 20% benefit cut. The biggest factor here is what many call the baby boomer exodus. This isn't just a handful of people retiring, it's a massive demographic wave. Picture this. In the 1950s, after World War II, we saw an unprecedented boom in births. Those individuals, now in their late 70s and 60s, are moving en masse from being net contributors to the Social Security system, paying into it through payroll taxes, to becoming net recipients. This shift is starkly visible in what actuaries call the dependency ratio. Back in 2000, there were about 3.3 workers contributing for every Social Security beneficiary. By 2022, that ratio had already dropped to roughly 2.8 workers per beneficiary. The latest projections, according to the 2023 Trustees Report, show this worsening to a projected 2.3 workers per beneficiary by 2033. This means fewer hands are actively putting money in, while more hands are taking money out. Adding to this, people are simply living longer. Advances in medicine and healthcare mean that someone retiring today, say at 65, might expect to live well into their 80s or even 90s, drawing benefits for 2 or 3 decades. This increased longevity, while wonderful for individuals, compounds the demographic issue for the system. Fewer new workers are entering the system due to lower birth rates since the 1970s, failing to replenish the contributions needed to support these extended retirements. The lesson here is that this isn't a problem that will magically fix itself or one that can be punted indefinitely. It's a mathematical certainty driven by our changing population. So, given these deep-seated issues, what about the so-called easy fixes we often hear debated? But what if I told you the easy fixes you often hear about are actually mathematical non-starters? Take the idea of just cutting benefits for the rich. It sounds fair, right? If we means-tested benefits and cut them for households earning over, say, $200,000, that would solve everything. However, according to the Social Security Administration's own actuaries, even completely eliminating benefits for the wealthiest 10% of retirees would only close about 11% of the long-term funding gap. That's a drop in the bucket when we're looking at a 20% across-the-board cut. The numbers simply don't add up because most of the benefit payments go to the middle and lower income brackets. Then there's the evergreen suggestion. Just raise the retirement age. We've seen this before. In 1983, under President Reagan, the full retirement age was gradually increased from 65 to 67, a move championed by then-Fed Chair Alan Greenspan and his commission. That reform provided significant solvency relief at the time. But today? Raising the full retirement age to 68 or even 70, as some suggest, would still fall far short of bridging the entire 20% deficit, not to mention the massive political hurdle it represents. The lesson here is that past solutions often don't translate directly to current challenges without significant additional measures. Another popular but misguided fix is invest the trust fund in the stock market. The argument goes, if only Social Security could invest its trillions in equities, it would earn higher returns, just like a private pension fund. But the Social Security Trust Fund is legally mandated to invest exclusively in special issue treasury bonds, which are backed by the full faith and credit of the U.S. government. Moving into the stock market would introduce immense volatility and political pressure, essentially making a significant portion of America's retirement security subject to daily market swings and potential government manipulation of investment decisions. This would create unacceptable risk. The lesson here is that perceived higher returns often come with a level of risk the system simply cannot afford. So, if these common solutions don't work, what does have a material impact, and why is nobody talking about the most likely outcome that affects nearly everyone? But what if I told you the single most effective solution to Social Security's funding problem is a hidden tax increase that virtually no one in power wants to discuss? The most straightforward, numerically powerful solution isn't about cutting benefits or means testing, but a modest increase in the payroll tax. We're talking about a relatively small adjustment, perhaps 2 to 3 percentage points total, split between employers and employees. According to the Congressional Budget Office, even a 1 percentage point increase in both the employer and employee share of the payroll tax, phased in over a few years, could eliminate a significant portion of the long-term deficit. Now, here's where it gets interesting. The taxable wage base loophole. In 2024, earnings above $168,600 are not subject to FICA taxes. Think about it. Someone earning $50,000 pays FICA taxes on every dollar. Someone earning $5 million stops contributing Social Security taxes once they hit $168,600. This effectively means their effective FICA tax rate plummets the more they earn past that cap. Senator Elizabeth Warren and others have proposed eliminating this cap entirely, or at least raising it significantly. The Social Security Administration's actuaries have modeled this, showing that subjecting all earnings above the current cap to the payroll tax, while still keeping a donut hole between the cap and a higher threshold, could inject hundreds of billions into the system, making it far more progressive. The lesson here is that the current payroll tax system disproportionately benefits higher earners after a certain income threshold, effectively shielding a large portion of their income from contributing to the system. So, while a direct payroll tax increase is rarely popular, there's a quiet debate happening about how to make the system fairer and more solvent, especially by looking at those who currently stop contributing FICA taxes well before the end of the year. But what if there's a way for someone in your situation to protect your future, even with all this uncertainty? But what if I told you there's a stealth strategy to fix Social Security that almost no one is talking about, and it involves a tiny adjustment to a little-known inflation formula? While politicians bicker over raising taxes or cutting benefits, the quiet game-changer lies in how we measure inflation for cost-of-living adjustments, or COLAs. Currently, Social Security benefits are adjusted using the CPIW, which tracks urban wage earners' spending. However, a subtle shift to a changed CPI or even a CPI, Consumer Price Index for the elderly, could fundamentally alter the program's trajectory and your future purchasing power. Consider the changed CPI. This formula reflects consumer behavior more accurately by assuming people substitute cheaper goods when prices rise, think chicken instead of steak. The Social Security Administration's chief actuary, Stephen Goss, has highlighted that switching to a changed CPI would lead to slightly lower annual benefit increases, typically by about 0.25 percentage points per year. While that sounds small, its cumulative effect is massive. According to the Congressional Budget Office, this change alone could save Social Security nearly $200 billion over 10 years, and trillions over decades, significantly improving the program's long-term solvency without a visible tax hike or overt benefit cut. On the other hand, the CPIE attempts to capture the actual spending patterns of seniors, who often face higher healthcare costs and different consumption baskets than younger wage earners. While potentially more equitable for retirees, the CPIE would likely lead to higher COLAs, thus worsening Social Security's financial outlook. For someone approaching retirement, understanding that your future purchasing power isn't just tied to benefit cuts, but also to this arcane COLA formula, is absolutely vital. If benefits are already facing a 20% cut by 2033, and then COLA adjustments are subtly reduced through a changed CPI, that's a double whammy to your retirement budget. The lesson here is that anticipating these indexing changes is crucial for realistic retirement budgeting. So, what this all means for someone in your situation is that relying solely on the headlines or the most talked about solutions is a risky play. The hard math tells us that a 20% benefit cut is a very real possibility, not some far-off hypothetical. But understanding the specific levers, whether it's the payroll tax, the COLA formula, or even just what truly constitutes cutting benefits for the rich, allows for a much more informed approach to your own financial planning. The lesson here is that doing nothing, or simply hoping for the best, leaves you exposed to these demographic and economic shifts. Now, I'm curious. Given what we've seen about the potential 20% cut, have you adjusted your retirement savings strategy in any specific way, or are you still counting on Social Security as your primary income? Share your thoughts in the comments below. And if you want to keep cutting through the noise with data-driven insights like these, hit that subscribe button. If you're looking for more ways to secure your future income, I'd highly recommend watching my breakdown of how much you actually need to save to generate a $50,000 annual retirement income, even without Social Security. That video will show you the exact numbers.